Have you guys seen about NYCB? A lot of trouble, but they good news. Let's see. So it looks like they were trading pretty much sideways. Come on. This is so hard. Yeah, so since 2020, they were trading sideways between like $8 and $12 for the past 3-4 years. Actually, for 20 years now, they've been like flat. They were up a lot in 2004, but ever since 2004, they've just pretty much been flat. You know, there are dips, but that's during like the Great Recession, during COVID, which is normal. But besides that, the stock really hasn't moved much until recently. It took a big dip. So it was $10 in January. Let's make this easier. So January 30th, it was $10. Then the next day, it was almost cut in half to a little under $6. Then it came down to below $5. That was on 2/6. So from 2/6 to 2/29, it was around $5 straight. And then it took another dive. Real recent. It fell to below 2. And they just got funding. So a bunch of investors headed by Steve Mnuchin put $1 billion into the company. And the stock shot up to over $4. It has regressed a little under 4. But I know I wrote it down, the investment returns. I'm sure I could find it, but so it was just yesterday, it was announced $1 billion, which is equivalent to $2 per share. Plus they get warrants with an exercise price of $250. So that's what drove the stock up. So it was under 2. And then Mnuchin and a bunch of other investors put a lot of money into it. Steve Mnuchin is he's in the Senate. What's his position? That's not the. He owns a firm, a hedge fund or a private equity firm. Okay, so he's a Secretary of the Treasury under Trump from 2017 to 2021. Is he still in the Senate? I guess he's not currently in the Senate, but he was. And he bailed out IndyMac during the Great Recession. I don't know if you guys remember IndyMac, the mortgage company. So in 2009, he led a group of investors to bail out IndyMac, which had been in receivership. So it was taken over by the FDIC. A lot of banks in 2008 were taken over by FDIC. Probably more banks than ever during the Great Recession. I bought 25 shares only yesterday after it resumed. Powell said there will be banks that collapse. There definitely will be banks that collapse. The commercial mortgage industry is very sensitive at this point. There's a lot of companies that are failing, and a lot of those companies have office space in these buildings, probably in the town you live in or in a big city. So if you live in near New York City, San Francisco, LA. Those big commercial buildings house many, many companies. So I actually do bookkeeping for a commercial a management company. We own commercial real estate. Mostly we lease out the space to businesses. We do have some residential, but it's mostly businesses. So I know it's a tough industry. It's especially lately. I mean, it has rebounded since COVID, but it's still not where it was. So the purchase price for IndyMac was $4.7 billion. Was a $4.7 billion discount to its book value. So that's called like a distressed sale. You know, when we talk about like acquisitions on the channel, like if a company has assets of $5 billion on their balance sheet and liabilities of $2 billion. So that means their equity or their book value is $3 billion. That's the value of the company. So pretty much like most companies, if they got acquired, they would get acquired for more than $3 billion. So usually, in this case, if somebody wanted to buy this company, they would acquire them for, say, $4 billion. And that means the new company would take all their assets, all their liabilities, which would give them $3 billion on their balance sheet. So they would have to book $1 billion to goodwill to kind of balance the balance sheet. Maybe the bonds have legs if you believe it survives. But in this case, for IndyMac, he actually paid less than the book value, which you can't really do unless a company is in really dire straits, and they, which a lot of these mortgage companies were. They got taken over. It's when you pay below book value, it's called a distressed sale. But the reason a company is willing to sell for below book value is because bankruptcy is kind of looming, or there's a lot of problems. And the problem, I mean, the reason it went down so much, I guess it took a while. I mean, it was trading. I mean, it was trading around 10 for a long time. So it's not like, and it was right in January, just less than 2 months ago, a real big dip. And the reason was because they had to post a reserve in the fourth quarter when they released their fourth quarter earnings. Come on, what is this? Okay. A reserve build resulted in 4Q loss of $250 million. So when a company posts reserves, banks, insurance companies post reserves. Any company can, but especially companies that loan out money. A reserve is not like they didn't lose anything. When you post a reserve, it's just like putting money aside, saying there's a likely chance we're going to have to pay a loss in the near future. So if they have loans of, say, $1 billion on their balance sheet, and these are loans they've given it to different people, say it's mostly commercial realtors, people who needed the money to buy a building or to buy development or a shopping center, whatever it might be. And let's just say historically they have losses of, let me see, say it's 2%. Let's go. Say historically they lose 5%. What is next? What is the next company that is going to post a reserve? I know this is what I try to figure out too, and it's very confusing trying to figure this stuff out. You get so lost in the numbers. But let me try to explain what it is, and then maybe we can figure it out together. So say historically the bank has paid 5% in losses because sometimes people default on their loans because they go to business. So like what's it called? Nycb loans $1 million to someone to get a loan for a building, and that person takes the loan, fixes up the building, whatever they need to do, and then they lease it out to other people, and then the lease payments are used to pay back the loan. Sometimes things don't go as planned, so sometimes people don't go bankrupt, but they might have to renegotiate. Like they said to the bank, "Listen, I know I have to pay you $10,000 a month, but I just really can't afford it, and I don't want to default on my loan. Can I pay you half, $5,000 a month, and then maybe after a year we can resume the $10,000." So it's kind of like they renegotiate the terms, which is a kind of a loss. But let's just say the people they loan money to are doing worse than they anticipated. So they initially said, we have a 5% loss historically, but then now they're going to change it. They're going to say this $1 billion, I think we're going to lose a lot more than 5%. I think we're going to lose 10%. Like they didn't lose anything yet, but they anticipate based on the people they lend to. They've been talking to them, and they see a lot of them are struggling. Some of them aren't filling up the buildings. They have a lot of vacant spots, so they have to raise their projections. So they initially had a $50 million reserve put aside for losses, but they're anticipating more losses. So they have to post a $50 million. Let's just make it, let's pretend, let's just make it 15%. So the number is different. So they say, it looks like losses are going to be a lot higher than we anticipated. So they have to post a reserve of $100 million. So they have to add $100 million to their reserve. So they have to put another $100 million on the side in addition to the $50 million. When they do that, even though they haven't paid anything out yet in losses, they're anticipating it. But when they do post reserves, it's put onto the income statement as a loss. This is the balance sheet. Okay. Loans and leases, 1.2 billion. Well, I know they posted. Where do they? Okay, so let's see. So this is the income statement. The interest income, 1.2 billion. So total interest income, 1.4 billion. Expenses, because they have to pay interest to the people who put money into the bank. That's an expense to them. The CDs you have to pay back to people. Here it is. Provision for credit losses. So this is provision for credit losses is the reserve. When they have to post this, in my example, it's $100 million, but they actually had to post 552 million as a reserve. So they're they're letting the investors know, and they're letting everybody know that it's likely they're going to have to pay 552 million of losses. And you can see in prior quarters, it was much lower, 62 million, 124 million, because you usually have to add reserves because you're constantly loaning more money out. It's not like you loan out $1 billion and you never loan out money ever again. Every single week, you're loaning more and more money out to different people. Some people are paying their loans back. So it's kind of like a cycle. So they usually are posting a reserve. Of course, say next quarter, they may post a gain here because they might say, actually, we were a little too conservative. It doesn't look as bad as we thought. We thought we were going to pay a lot of losses, but after doing more research and talking to our tenants, we actually think we posted too much a reserve. If that happened, the stock would shoot way up. It's unlikely they would reverse it. So that's why the stock crashed. They post this huge reserve. So it's kind of letting investors know losses are on the way. So during the fourth quarter, the company recorded a $552 million provision for credit losses. So they didn't pay any losses. It's a provision. Provision for credit losses. What does provision for credit losses mean? The provision for credit losses is an estimation of potential losses that a company might experience due to credit risk. So it's not cash. The provision for credit losses is treated as an expense on the company's financial statements. Because that's why the income statement isn't cash. It's just accounting. And that's compared to 62 million in the prior quarter. So it went up almost 10x. And they're working, they're on the inside. They're the people at the company, they know what's going on. So they know their portfolio better than anyone else. So of course you're going to believe what they say. Because like a YouTuber like me, I can just go through their reporting and just say, oh, look at this, look at that. But I don't really have inside information like the company does. So they credit loss of 552 million. The increase is attributable to higher charge-offs, as well as to address weakness in the office sector. So office space, especially in New York City, I think. Potential repricing risk in multifamily portfolio, so also residential. So they do mention there were charge-offs, meaning if I took a loan for $500,000 to buy a home, and I was like, listen, I lost my job, I need to renegotiate, and they want to negotiate. They don't want to have to like put me into foreclosure and take the property over, because that's what would happen. If I couldn't pay my loan, they would just take my property and then try to sell it in an open market. But they don't want to deal with that. That's a headache. So they may say, okay, you're paying your $500,000 loan 5%. So we'll give you a deal. We'll give you we'll knock it down to $400,000, but you have to pay 7%. But let's just say this was 20 years. So they say, okay, we'll do $400,000 for 7%, but that's over 30 years. So it lowers my monthly payment because it gives me more years. So that's like a charge off. They knocked off $100,000. They will make it up in interest. Nycb can't just sell their losses to another bank as junk. You know, the whole financial crisis. Well, they could sell it if someone's willing to buy their loans, but not the junk loans. I guess they couldn't sell. But this isn't if I was gonna like make a video, usually I would go through their investor presentation, and it always sounds great because they obviously highlight the real positive stuff. Like we reported net income of $2.3 billion. We're more diversified than before. Commercial loans represent 46% of total loans. So they highlight all the good stuff, and they hide the bad stuff. And if you don't really know that much about this stuff, even if you do know a lot about this stuff, it could be hard to identify like, oh, this company's in trouble. Like before they actually posted that reserve, a lot of people didn't know they were going to be in trouble like this. If they did, people could have made a lot of money shorting the stock. But yeah, so you just see these tables, and it's just total deposits. So total deposits is money people put into the bank, like into savings accounts at this bank or checking accounts or CDs. And that's how they make money, because they take those deposits and lend it out to others. So 81 of deposits, 26% of that is CDs, 11% is savings, money market accounts, 16% non-interest bearing. So that could be just a no interest savings account, interest or no interest checking account. Then interest bearing checking, 22%. And they take that money and they loan it out to different people. 44% of the money they loaned out, 44%, they loaned out $85 billion, even though they only had $81 billion in deposits. 44% to multifamily, 12% for commercial real estate. CNI, what's CNI? Consumer, commercial and industrial. Okay, commercial and industrial. Warehouse lending. Warehouse lending is people who have like a like debt, like a loan facility. A, D, and C, 3%. See. Okay, acquisition, development, and construction loan. So they just give you all this high-level stuff. It sounds great. 64% of their deposits are insured, 33% uninsured. So if you have $250,000 at the bank, you're insured. But if you're over 250, say you have $500,000, only half your money's insured. The other half is uninsured. You think it's going back to 10? There's a lot of speculation that the $1 billion isn't going to save them, but I don't know. It's hard to tell. It doesn't seem like $1 billion would save them, but average NPLs over total loans, the S&P. So non-performing loans, the gold is them, and the silver is the S&P banking index. So you can see non-performing loans, they're doing a lot better than S&P. Recently, they're actually the same as the S&P. So you would look at this and say, oh, they're not doing so bad. But it's kind of like when COVID first started, and there was there was like 500 people have died from COVID in when it first started. So you think, oh, that's not a lot of people for the whole United States, only 500. But the estimation was that it would be in the millions if things continued. So it's kind of like before things blow up, it doesn't ever seem that bad. That makes sense. Mnuchin was never in the Senate. He was only Secretary of Treasury under Nycb, an investment banker and a filmmaker. He was Secretary of Treasury. That's not. Oh, I guess I meant he was he had a government position. So non-performing loans as a percent of total loans held for investment. So you can see like, oh, look how only 0.5% of our loans are non-performing. We're better than almost everybody else. But it depends. Just because like today you only have 0.5% of non-performing loans doesn't mean in 2 years it's still going to be the same thing. Because it's kind of like it's not like a slow burn. It's like it just out of nowhere it just crashes. Kind of like the Great Recession. It didn't seem like there was a problem until it kind of imploded. They only have 12% of commercial real estate loans, so you would think, oh, it's a good portfolio, because 44% is multifamily. But you need to know like the credit terms or the risk of the people they're lending to. If they're lending to people who are in really risky cities, low income or people who are really levered up, debt service coverage ratio is something to look at. So how many times the people they lent money to, the regular people who bought homes, their DSCR, the higher the better. How many times can they cover their debts? Almost 2 times. It's kind of like the current ratio. You want it to be at least 1. But if it's 2 or 3, there's more of a cushion. Loan to value. So the lower the better for loan to value. That's a good loan to value, 61%. Because if you have a $1 million home, I'll put on the bottom. So the value of your home So say you get a loan for $800,000. You put 20% down. So the LTV is 80. That's how they loan to. Oh, they're doing percentages, but okay, 80%. So 80% of the home has debt on it. So that means if you sold the home today, if you were able to get $1 million, you can pay off the entire loan. But as time goes on, say 3 years after the loan, you'll probably be paying down some of the principal, hopefully. So maybe it's down to $700,000, the loan. And actually, maybe it's worth more money. Maybe the value of the home, it goes up to 1.1 million, it goes up 10%. So now your LTV is even more attractive, 64%. So even if you defaulted, the bank doesn't view this as too risky, because even if you defaulted, they can just take your home, sell it, and even probably sell it for less than 1.1 million, probably sell for 900,000 just to get the sale done and not sit on it for too long, because they just want to recover their loan amount. They're not looking to make a profit. So yeah, so lower to better for LTV. 61% is a good LTV. The average balance is 8 million. So I think multifamily isn't like people like me and you. I think it's investors who buy like like 3 units, or like homes connected to each other, like or one really big home that has 3 separate floors and entrances, or maybe a little condominium development with like 7 homes. The occupancy rate is 96%, so it's highly occupied. So it seems like, oh, this is a really, seems like a low risk right here. It seems like this is really good. And they also have rent regulated portfolio, where the spaces that are rented are regulated by the New York City. I think the big risk is the commercial real estate, especially the office. I think that's the real big risk. So more than half their portfolio is in Manhattan, which I think people are looking at as a potential big problem as more companies go bankrupt or struggle to just pay their employees. So reserve coverage. So they have an 8% reserve, which seems pretty high. That means they're going to pay losses on 8% of their portfolio. Non-performing loans, 84 million. Charge-offs of 42 million. So yeah, so just a lot of numbers, a lot of. It could be. Okay, they're second. They're ranked second in terms of lenders. JP Morgan is number 1. Flagstar, which is their parent company, is number 2. So they're second in. Oh, that's warehousing. So warehousing is like a line of credit. What is warehousing lending? It's a way for banks to provide loans without using its own capital. Financial institutions provide warehouse lines of credit to mortgage lenders. The lenders must repay the financial institution. So yeah, it's a line of credit. It's just another way to get funding. It's slightly different than a traditional loan that's backed by real estate. So yeah, so what do you guys think? You think it's I mean, it had a real big jump. Yesterday had a real big jump yesterday. So if you could have caught it at the bottom, that's really your best bet. Look how low the RSI was. Right before that big jump, it was in the teens. Usually under 30 is a buy. Now the RSI is in low 40s, which is still pretty much a buy. But okay, I got to get going. just wanted to fill you guys in on NYCB in case you were curious of what happened and why it went down, then went back up. Okay, so I'll talk to you later.